Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending July 31st, 2020. This is a daily chart of the Dow Jones Industrial Average. And what I want to kind of address first was for the last couple, actually for more than a month, in the videos and especially for my members, I've been saying, look, we have a lot of technical support or resistance, depending on the average, in the area, like the 50-day here, the 200-day on this daily chart of the Dow. And we're going into earnings season, and the market typically rallies into earnings season and then kind of goes flat through earnings season. So that was the point I was trying to make. I think this is where we actually kicked off earnings season with the big banks. The Dow is 0.5% changed. In other words, like this 200-day moving average in blue, pretty much flat. So the reason I really brought this up, I know it's not a very exciting thing to hear, is because it gives you some expectation of the probability. So when I structure my trades, I'm keeping this in mind. So I'll usually have shorter trades where I'll just try to scalp a little something. I'm not swinging for the fences for big directional moves until we get through that earnings season, or at least until the market starts to get a feel for it. Okay, so that said, let's take a quick look at the averages on the week. The S&P 500 here on a daily chart, it was up 1.73% on the week. Here's that island top, it filled that, but we're still just really kind of going sideways over here. And if you look at Friday, let me zoom in a little bit. Looks like a hanging man candle over here. Friday was actually a really bad day. It was only the mega cap stocks that were up that had reported the night before, and certain ones of those weren't even up, like Google. Here's the S&P on a 10-minute chart. So from last weekend's video, we were down in here, and I said I thought that we were going to bounce a little bit or not really sell off too much more because the Fed was coming up and because of earnings season. So this is kind of the channel that we're trading in. It has a little bearish bias, kind of like a flag. And this area right here, it's 32.30.78. That's S&P's year-to-date unchanged mark, and this has been like a magnet for prices for quite a while. Here's the Nasdaq 100. It did the best on the week, up 4% on the week. Since this key reversal day, and this was the most violent key reversal day the Nasdaq's seen since March of 2000, about 3 weeks before the market topped. In any case, since then, it looks like a zone of big distribution right in here. You can see this kind of lateral zone. Anyway, on Friday, another hanging man candle. But if you take a look at prices, for the last 3 weeks or so, 0.6%, it's pretty much unchanged, going sideways with a lot of volatility. I have mentioned that it seems like we're seeing some distribution up around this 11,000 zone up here at the top of the range. And here's Nasdaq on a 15-minute chart. So this is the key reversal day. This is 11,000. So you can see dumps, kind of consolidates, corrects back up, gets sold again over here, dumps, does the same thing. This looks to me like distribution. And from QQQ's perspective, you could do this with the Nasdaq too, but I'm just showing it with QQQ. Had this channel really since April that it has been trading in. You might remember last week I had shorted it up around the top of this channel and took profits down in here. But you can see it's still respecting this channel, and I would imagine it probably will until we get through earnings season. But now that the mega caps have all reported, maybe that starts to unwind and change next week. So we'll see about that. Okay, back to the Dow daily chart again. This is the island top. It did fill that gap. But this is what we've been doing since earnings started. The 200-day moving average just flat, going sideways. The 50-day moving average. You can see both of them were tested Thursday and Friday this week. These 2 days really got ugly. Apple bailed out the Dow over here. It's one of the Dow's components. Bailed out the Dow on Friday. But you can see what I'm talking about. We're in earnings season, and these technical levels are really magnetic. They're holding up. And on a 60-minute chart of the Dow, what do you see? It's like a big descending triangle. It's actually a bearish triangle. The formation is bearish, but because it came after an advance, it kind of neutralizes that. The point is going sideways. Here's IWM for small caps. Again, up 0.9% on the week. Look at this 200-day moving average, and price is just hugging that. So did break down below that Friday. Again, like I said, Friday was a really ugly day under the surface. Prices probed down below that 200-day moving average, and just like it has every other time for the last 2 or 3 weeks, held support there. So that's around 146. Really, it's a narrow range here. And if I pull it up on a 60-minute chart, you see the same thing, going sideways in a big triangle. And this is what I want to make my members and anybody who's listening to the video aware of before we went into earnings season, so you'd understand that you weren't taking big directional bets with a whole lot of leverage. Here's IWM with 3C on the week. Here's the start of the week. So you can see kind of like in line in the beginning of the week. As we get up to the highs midweek, negative divergence, price comes down. We get up to the highs over here again, negative divergence, price comes down. Friday, I pointed this out to members as we were near the low of the day. I said, look, I think they're going to try to close the averages the best they can in front of the weekend and hold those technical levels like IWM's 200-day moving average. This is where it was below, and we got a small positive divergence right there, and prices just ramped into the close on a $4 billion market on close imbalance. And obviously that was on the buy side. I'm not going to spend too much time on S&P sectors because it's really more influenced by earnings. There was a little bit of rotation out of the value cyclical sectors, the growth sensitive stuff, and into momentum tech, but that was really more just about earnings. So the best performing sectors on the week were first technology at 5.1%, obviously, and the defensive real estate sector actually at 4.2%. The worst performing were energy, down 3.75%, banks, regional banks down 2.5%, materials down 1.8%, and biotechs down 2.6%. Like I said, we did get rotation into cyclicals values like energy out of mega caps after that distribution day or key reversal day in the Nasdaq. But as you can see with the energy sector here, which was one of the beneficiaries, it really has done nothing with it. That's the 50-day moving average. It's been trading under it the whole time, feeling some resistance, as you can see. One of the interesting things last week in sector performance was that I saw a defensive bias a little bit more often than we've seen recently. So here's the real estate sector on a 30-minute chart. Let's go to 60-minute chart. Like the other averages I showed you in triangles going sideways, broke out of that this week. So again, this has a little bit of a defensive kind of flair to it. Also, that momentum style factor. If you are a member, subscriber of mine, then you know that I have been watching the banks like a hawk. So this is the KBW Bank Index, a weekly chart. That is the Great Financial Crisis. This is the March sell-off, February-March sell-off. So take a closer look real quick. There it is on a one-day chart. This was like the best I've seen the market look right here. When banks broke out, yields moved up, curve steepened. It was about a 2-week period, and then it changed real fast. So I've been watching the banks for another short entry. It did really well on the Wells Fargo trade. I think a lot of the elements that make it a good trade are in place. I'm just more looking at it from a tactical perspective because, and this is a daily chart of the banks, BKX, because like everything else, they're just hugging these moving averages. This is what I was saying, this is why I haven't taken a swing. All the conditions for me to sell short banks are there. I would have done this weeks ago if it weren't for earnings season and this thing I've been telling you about, about earnings season going sideways and hugging these powerful technical levels like that 50-day moving average. Touching on volatility real quick, 3 of the last 4 weeks we've seen some unusual action early in the week in volatility that has given away kind of what was going to happen the rest of the week. Got a few trades off based on just what was happening in volatility. This week didn't see it so much. VIX down 5% on the week. Nothing too interesting down below this 200-day moving average still. On, Thursday night, I think in the daily wrap, I posted an indicator that I love for trading volatility for volatility signals. Only gives them maybe once or twice a year, but when it does, they are spectacular. They've just been great. Every time I see them, I buy volatility and, expect to hold for a couple weeks to a month. Usually volatility will make a double-digit move, a lot of times about 50%, often more, within 2-3 weeks of getting that signal. Point is, I started talking about it on Thursday because that indicator was moving close to giving a signal, moved a lot closer on Friday. So this is the S&P 500. It's a 30-minute chart, and this is the indicator I was talking about. When it makes like real low readings and below, I use a certain level like around 15, below 15. You can see it hit 1971, 1950 on Friday actually. When it gets down to these really low levels, you often see volatility make pretty big moves. Let me change S&P 500 to VIX. Okay, so this is the indicator in white, and this is VIX in red and green. This is a breadth indicator. It's scary. Look how they track together. But the point is, when we get really low readings, like over here, you get these huge moves in volatility. So in that daily wrap, I included a post that you can go back and take a look at this much closer. You can read all about it. But what I did right here is just put a true condition in blue when this indicator drops below 15. Okay, so below 15 shows it in blue here. I think the last trade that I bought VIX based on this indicator was, I think, right over here. And we got a 50% move over the next 3 weeks, I think it was. We've seen some much bigger moves too, like over 100, 200%. that big volatility shock back here. It's moving down towards that level. And the reason I brought it up last week is because it started moving really fast. You can see here is where we started the week, and here's where we ended it. And it's kind of interesting that it's moving so fast as we kind of get towards the end of earnings season. Let me touch on rates real quick. On the month of July, the 2-year yield dropped 8 months in a row. The 30-year down 5 months in a row. And the 2s30s curve flattened the most since August of 2019. August of 2019 was like peak recession fears over the trade war and all that. And if we take a little closer look this week, you can see this is the 10-year yield just dropped down pretty sharply. And let me show you the curve real quick. This is the S&P 500 15-minute chart, and this is a proxy for the 230 curve, okay? So you can see really flattening. It shouldn't be doing this. It should be steepening when you're going into a recession and the Fed is doing everything to bring you out of recession. You shouldn't see the long end drooping compared to the short end. You can see over here the curve was leading lower. Looking a little bit closer on the week and kind of as we get into this earnings season, here is the start of June, that payrolls report where everything kind of changed. This is about where earnings season start. So you can see what's going on here. And this is one of the reasons I like the bank idea. It's just not good for banks. Both lower yields and a flatter curve are not good for banks. Now let's touch on where the real action was this week, and you can look at last weekend's video, just the name of it alone, you know probably what it is. So this is Silver SLV ETF. So again, another great week. Silver had the best month in 40 years in July. Gold had the best since 2011. Spot gold prices record high. Here's GLD on a 60-minute chart. GLD added about 3.8% this week to cap off the month. And you can see it's just been this huge spike ever since we broke out of this kind of bull flag over here. So to me, it's just gone a little bit too far. As a matter of fact, last weekend I showed silver, or SLV, and just how parabolic this spike has gotten. So if you take a look at the price action this week, it's getting more volatile. Here's GDX, gold miners. They added 2.65% for the week. So I got long gold miners over here. I got out of gold miners over here at my target, 41.25. This week they hit the full measured move target at 43.25, and look where they pulled back to, right there, 41.25. And the reason I use these targets is not to say that they can't go higher, but to say that this is generally speaking where you'll see them consolidate like this, and then I'll look to get in again. Here's SLV on a 60-minute chart. So it did add some gains to the week, 6.8% early in the week. But if you take a closer look at price, it's getting real volatile. It's not saying that silver, I wouldn't go short silver, I wouldn't go short gold, but volatility is rising. This is a weekly chart of gold's volatility index, so it gained another 13% this week. I pointed this out last week. The last time it gained all this volatility in February and March, gold, to me, was uninvestable. And I said it's going to take some time for it to come down, for the volatility to come down, for prices to consolidate. That's what happened. On this 2-hour chart of GLD, this is where it hit our measured move target, then volatility got insane. Look what the price did. It just got crazy, right? It took a couple months for it to consolidate before it got constructive again. So my point is, I still like gold, I still like silver, I still like gold miners, but this move to me is just too extended. The volatility is rising. When volatility rises, price gets unpredictable. It does crazy things. It doesn't act like this. This is where I love gold and I love silver. Up, consolidate bullishly, up, consolidate bullishly. The only time it doesn't do that is when volatility rises. So the point being, I'm not chasing gold, silver, or gold miners higher. I'm waiting for them to pull back constructively, to consolidate constructively. Then I'll take another look. I'm still bullish on them. I just don't want to chase them higher with that kind of volatility. And that really goes for any asset class. If you're going to be long something, you want it to have low volatility. Low volatility means it trends nice like this. You get into high volatility and it gets real choppy. If I'm short something, I like high volatility. The big performer for us this week was GBTC, Grayscale Bitcoin. Here it is on a 60-minute chart, up 23.5% this week. This is what I've been waiting for. I've been saying this is a bullish flag, consolidation, waiting for that breakout. So up almost 24% this week, blew away every other asset class, blew away Apple's big 10% move on Friday. Very constructive price action. I love it. I'm not worried about the price action at all. Consolidates here, I may buy some more. But it didn't just break out of this big bull flag. And for me, the bigger these are, the better. Okay, I know it takes a lot of patience. You got to sit through drawdowns and everything, but as long as price stays constructive, the more energy it stores up in here, I think the more it can rally. The more impressive and more meaningful thing for GBTC and for cryptocurrencies generally, this is my flag over here. Check out this trend line over here coming in around 11. Go to a weekly chart. Look at that. That's our breakout this week from this huge, this is a multi-year bullish consolidation. It came from, remember when Bitcoin just went berserk in 2017 over here, went parabolic? Well, this is how long it took for it to consolidate. This is a bullish consolidation because it's coming after this uptrend. This is the start of the breakout. But I think that's nothing compared to what this can do. And this is coming at a time, when the U.S. is printing and just dropping money out of helicopters. You're seeing gold rally, you're seeing silver rally. These are real hard currencies. They're not fiat. And you're seeing cryptos rally. Let's look at some other commodities. So what I want to do is show you copper. So these are copper futures on a 30-minute chart. This is 3C. You could see 3C has not been confirming very well. Actually, the copper futures look a lot like crude. What they did, though, and what I wanted to point out was they broke a trend this week. So it's not the most horrible trend break or anything like that, but it's a change in character. Change in character leads to or precedes changes in trend. You can see 3C hasn't been confirming very well. Let me show you crude did the same thing. Here's a 60-minute chart of crude oil. You can see this trend. It's really been struggling here to get above 42. There's a lot of overhead supply. Hasn't been doing a lot, and I've said to my members, I'm not trading crude until it comes up to this 42 area. Then we'll see what it looks like. You can see 3C's not been confirming. Breakdown in crude, breakdown in copper this week, both of them, as yields drop as well. Now, copper's been surprisingly resilient, but that's mostly a supply side issue with mines shut and all that. Yields have been saying that copper should be lower, and gold has been saying that copper should be lower. Okay, so what you're looking at now is the copper to gold ratio over here in red, and this is the 10-year yield. This is the payrolls report, May payrolls report that was out June 5th, where we saw that big change in character in the market. So since then, copper gold ratio has been going this way, yields have been going that way. These two generally confirm each other. So let's move forward a little bit, this chart. You see yields are moving lower. They're suggesting that two things. Gold prices should be higher, copper prices should be lower, and that's what we start to see happening here, this ratio falling. The bond market was right. The commodity market is now reflecting that with gold outperforming copper. So I guess, there could be a pairs trade in that, long gold, short copper, or something like that. But we're looking for this to come down and confirm, revert down to what yields are doing. And here it is all the way out on a daily chart. So you see the same thing. They tend to confirm each other. The only time they didn't was right here. This is when Powell was still pushing rates have to go higher, and the market crashed after that in October of 2018. That's the only time you really saw this big divergence here, and that was because of central bank policy. My bigger point, though, is the economic signal that that's sending in that copper. Crude breaking down. You're seeing gold outperform. These are not the kind of signals that you see in a market that's rebounding economically. And one final asset class that may affect all of this, the US dollar index. Here it is on a daily chart. It has been mugged. I mean, this is in March where everything was going crazy. People were going to cash. The Fed did all their stuff. They've kind of broken the dollar, and we can take a closer look. I mean, it's been horrible for dollar bulls. But one thing I wanted to point out, remember this is a daily chart. Friday, we saw a bullish engulfing candle. So if the dollar goes up, what happens? Since March, the dollar and the S&P have basically had an inverse relationship, meaning dollar down has been good for stocks. Dollar up has been a headwind for stocks. Gold tends to benefit from a weaker dollar. Commodities like crude, copper, same thing. And we've been taking a look at emerging markets. Well, emerging markets benefit big time from a weaker dollar. So the point is, we did see this bullish engulfing candle. This may be a reversal. It comes at a very interesting point for the dollar. This is the dollar index. This is about 2011. So look at this trend. That is where the dollar ended on Friday, right at that trend. It's a meaningful level, and we saw a meaningful response from the dollar. So this could flavor everything from equities to commodities. Maybe we get that gold pullback, who knows? It could have a really big effect on the market in the next couple of weeks. So you want to watch how the dollar reacts as we go into next week. This is FXI China 25 60-minute chart. I got short right here. I actually did close out that short on Friday. I had two downside targets from where we got in over here. One was just a gap fill over here around 41.50. So it hit that target. The other one is a measured move from the price action, and that came in more around 40.70, which could also fill this gap over here. It still looks bearish to me. The price action looks bearish. The 3C chart looks bearish. You can see these consolidations where it kind of corrects, and 3C is negatively diverging. Matter of fact, I was thinking about closing it out with the trailing stop here at 42 earlier this week. Negative divergence into that, left it. So I closed it out right here at the low, or towards the low on Friday. Here's EEM for emerging markets. FXI and EEM track really similar, and this has more of a bullish kind of ascending triangle, and we've been looking at this. If you are watching this, you're going to want to watch what the dollar does moving forward, because the dollar strengthens, these are going to get hit. These two track very closely to each other. So EM is on the radar as we move forward. But as far as FXI goes, the trade basically was a double, made 100% on the trade, and it just didn't, the risk reward to get 75 cents or so it just didn't appeal to me at that point. So I'm not bullish on FXI here. I just didn't see the risk reward making sense at that point. So let me wrap this video up. It's getting really long. Going into next week, obviously, lawmakers in the U.S. are still haggling over the contents of this next coronavirus relief bill, so the market's going to be watching that, of course. I think on Friday we may have seen kind of some month-end window dressing dynamics, so we may see some more of that early in the week. Pay attention to that. Earnings season will continue, but with those mega caps out of the way, I would suspect at this point the market's got its feel for earnings season and what's going on in the economy, that it will start to make some decisions and we'll start to see some more movement. And remember, with that volatility signal that we're getting, that's kind of interesting too, where that's kind of popping up, because we haven't seen that in several months. The dollar, I think, could really be key, so watch the dollar as we go into next week and moving forward there. And one last thing to point out is, although all this is happening, the market's kind of flat through earnings season and all that, there's still a lot of hedging by pros, buying deep out of the money puts. This is the skew index. It is the highest, really just a couple days before the market crashed over here. This is professionals hedging by buying deep out of the money puts. They're bidding them up. That's why the skew is rising. So we still have this going on overall. I'll leave it off at that. Have a great weekend. We have a hurricane actually barreling down towards us right now. That's why I want to get this video done, get it out before I may lose electric and internet and all that stuff. If you like the video, please give it a thumbs up. Check out the website. I have the link in the video description. And as always, please leave comments and questions. I try to answer them all. I really appreciate them.